Good morning. My name's Roger Basinger. I'm with the Kansas Department of Revenue. I'm a tax specialist in that office. And hopefully you're here today for the Kansas Retailer Sales and Compensating Use Tax Workshop. Uh, Welcome. We're glad you're here. Hopefully we can provide you some good information today. Uh, if you have any questions during the presentation, please raise your hand or do something in chat, and we will try to address that while you have questions. At that point, I have with me today Carl York. He's also a tax specialist in the office. And so he will maybe try to help me a little bit watching for questions and stuff. So if we can maybe, like I said, we will try to address that as we're going through. Uh, Again, Carl and I really focus or think our job is education. So we really do welcome your questions. To that end, you will see that there is contact information, direct phone numbers, and email addresses for both Carl and myself. So if you have questions during this presentation or after the presentation and you want to reach out and either send us an email or give us a call, please do so. Like I said, we'll try to address your questions one way or another in one of those methods. Uh, so, like I said, do not hesitate to give us a contact or contact us and ask questions. So hopefully, like I said, we'll give you some useful information today. And again, education, not audit. So anything we talk about today, we don't turn around and talk to our audit group or share that information with them. We really want to try to have you educate you and have you trained. So if the auditors come in the door, you don't have any problems to deal with. So with that being said, that's our hope, that's our desire. But with that, anything I tell you today is not necessarily binding. That does not mean we're not trying to give you good information, but a lot of times when we're talking hypotheticals and that type of thing, we don't necessarily have all the information, all the facts and circumstances. I believe the IRS calls this the totality of the facts and circumstances. But sometimes when we're just discussing this, there may be elements that are left out. And some of this stuff is very, very complex and can really hinge on a certain fact or circumstance, whether that's present or not. So again, like I said, we're trying to give you good information, but it is not binding. Anything I tell you today, it is not binding on the department. However, with that being said,
Hey, Roger, I don't think we are able to see your presentation.
okay. Well, let's try this. So you're just seeing me then?
Mm-hmm. Yeah, it's visible now.
Are you seeing it now?
Yeah.
Okay. All right, so we're good? Everybody's seeing it? Okay. If not, let me know and we'll try this again. If you do want a binding decision from the department, we do have a method of doing that, and that is called a private letter ruling. And that comes under the Kansas Administrative Regulations 92-19-59. But part of those guidelines are basically, if you want a private letter ruling, it has to be in writing. emails do count. So you do not necessarily have to write us a formal letter, but you can send us an email. If you do send us an email for your private letter ruling request, you would send it to that address, kador_tac@ks.gov. That is our Taxpayer Assistance Center. So that is the first stopping point for emails coming in. It's probably very important that if you're writing that and sending that to that address, that you put in the subject line that you're requesting a private letter ruling. And it would also probably be very helpful to put it to the attention of Policy and Research. And that's the office that Carl and I work in. So again, like I said before, those requests have to be in writing. And when you ask your question, please be as specific as possible and share as much information as you can. Like I said, a lot of these issues are very fact-driven and really can hinge on a certain fact being present or not. So again, be as specific as possible. Kind of think out of what your next 2 or 3 questions may be. And like I said, if it's something that we may not be familiar with, Carl and I may have some background in tax law and that type of things, but we may not necessarily know the specifics of your industry. So sometimes if you can take a picture, that may help us see what you're actually talking about, particularly if it's equipment or how it's installed or applied. So that can be very, very helpful also. A couple of other criteria is that you should have an active sales tax account. Again, private letter rulings are for an actual fact pattern or issue that's out there. It's really not for hypotheticals. And the issue cannot be an audit. So basically, if you're being audited and they're looking at that particular issue in the audit, you cannot ask for a private letter ruling while that audit is still taking place. We did have a situation just this last week where we did get a request for a private letter ruling, and while the company itself was not under audit, they were doing business transactions with another company that was in audit, and those transactions are being called into question. So at that point, we had to stop and back off. So again, the issue can't be an audit, or it can't be, or your company can't be a related transaction that may be in the audit. So keep that in mind also. With all that being said, though, we really do try to research these. We draft them up. We usually have people take a look at them. There's usually a group of us. We really do kind of sit around a table. Hey, have you thought about this? What about looking at it from this perspective? So we really do spend some time and effort in issuing these private letter rulings. With that being said, once it is issued, that the letter only applies to the taxpayer who asked for it or to who it's issued. It cannot be cited or relied on by another taxpayer, so it is really a very specific to the person asking for the private letter ruling. But it is your get out of jail free card. So if an auditor walks in and looks at this particular issue and says, hey, we don't think you're doing this right, and you can go and say, hey, we did our due diligence. We went to the department. We asked for that. We had them look at the issue, and this is what they told us, and we're trying to comply with that. And so that is your protection in an audit. So like I said, those private letter rulings are very, very useful. So like I said, if you really have an issue that you really need a binding decision from the department on, that is probably an avenue you would wish to examine or explore. With that, we'll actually get to start talking a little bit about retailer sales tax here in Kansas. It has been around for a while. It has been, sales tax was enacted in 1937, so it has been around for about 85 years. You can see that table on the left-hand side of your screen. Back in 1937, we started at around 2%, the state rate anyway. Presently, we're at 6.5%. So you can see how that sales tax has grown over the years. Carl did some research way back when he was doing this, and he came up with those nifty graph and those meals. Those two little coin-looking items are called meals. And when the sales tax first started here in Kansas, you would have a 2% meal and a 1% meal, and the 1% meal has a hole in it. And at that time, and in this case, a meal is 1/1000th, or it's 1/1000th of a dime, or 1/100th or 1% of a penny. And so these meals were used for relatively small transactions. So back in 1937, you may actually have been able to purchase something for a penny or something. Well, there was still a sales tax due on that. Well, we can't, collect another penny. I mean, so these meals were in effect, and that's what they were basically used for relatively small transactions. And while Kansas was one of the first states to use a sales tax, and one of the first states to use these meals, we were absolutely the first state to get rid of those meal tokens or coins. They just weren't practical. They weren't popular. You had to buy them up front. So eventually, I think it was about after 18 months, they just kind of went by the wayside. But again, like I said, you see where the sales tax started in 19.
I'm sorry to interrupt, but I think the slide is still on the PIL slide.
You're not, okay. Are you seeing anything now?
Yeah, perfect.
Okay. Okay, we'll just go. Okay. Is it filling the whole screen?
No, it's not.
Here, let's see if we can.
It's not showing it in slideshow view on ours.
Okay. Let's see if we can.
Let me see if that. Now we see
Nothing.
screen.
Okay. Well, okay, so I do that, and then I start this. It's throwing it
And then
over.
if you minimize it over there, and then all you do is click on this one whenever you want to advance it.
But that's what I was thinking.
Let me see if it's.
Are you guys seeing the screen or the slideshow now?
No, it's not visible.
No, it's showing over there.
Yeah, it needs to get onto this screen. Let's see here.
So drag drag that over to this screen.
Okay.
And then do the slide show and see if it pulls up over there. Probably. Okay, see if you can, I guess it won't drag, will it?
No, I don't want to stop. I mean, I can do this. I can pull that over here, but they're going to see.
That's the view we have like that.
Yeah. Yeah, that's my.
I think you can just click the icon from current slide, which is on top.
Well, I think.
I don't know how to get it.
I know I need to get it over to the. Sorry, technology is great when it works, but we may just get to just kind of see more of it than you really want to. But as long as you're seeing this portion of it, as long as you're seeing that, we'll probably just go ahead and try to do that. Again, like I said, sales tax started off at 2%. It's currently at 6.5%, at least the state rate is. And it is the second largest revenue source for the state general fund. It only trails individual income. Sales tax is about 1/3 of state general fund revenues currently, and that brings in about $2.5 billion a year. So it is a great revenue source for the state. Sales tax in Kansas is actually can be comprised of like three components. There's a state rate, which is 6.5% currently. In 1978, counties and cities were given the ability to enact their own sales tax. So you may have an additional 1 or 2% for counties and cities. And then there's also the ability for counties and cities to maybe do community improvement districts or transportation development districts. And those districts themselves, they may be a small area inside the city or county, usually with some type of economic development. Usually the increased sales tax in those areas are used to help pay off the bonds and interest for the construction or the new improvements. So we take all those components together, the state rates, the county and city rates, and the special district or special jurisdictions, and we can come up with a combined rate of sales tax. So that is very helpful, but it is also very complex because it creates over 1,000 different taxing jurisdictions within the state. And it can be very, very specific also. I mean, we have a story about Legends in the Kansas City area, two businesses that are next door to one another. One of them is in one jurisdiction and the other business is in another jurisdiction.
Let me help you out here.
So,
go to slideshow.
okay, we're going to try this.
So hit escape. On there, yeah. Go to slideshow. Let me see, monitors. Go here.
Okay.
Do you want it on your primary? I don't know which one's your primary.
Well,
so then just go to So, okay, that's your primary. So go back here. So close that again. Go to, I think that one.
Okay.
Then,
Okay.
there.
Okay.
Let me see what we got here.
Okay. Hopefully you can hang in there with us. Is everybody still seeing that? Okay, so we're talking a little bit about sales tax rates, and it's comprised of three components: the state portion, counties and cities at their special jurisdiction. There are over 1,000 taxing jurisdictions in the state. So again, and it can be very, very specific. We can, like I said, you can have two businesses in certain instances next door to each other, and they may have a different tax rate, or you may have a business on one side of the street and another business on the other side of the street, and you may have a different tax rate. So makes it a little more complicated here. And again, when you add all that together, you can see that tax rate can exceed 10%. I believe the Ottawa Holiday Inn Express CID, that's one of the highest tax rates in the state with a combined rate of 11.6%. You can see there's some other CID projects in various cities that are very, very close at 11.5%. So again, and generally when you collect sales tax, you're going to collect it on the combined rate. So you're going to take into all those jurisdictions if you're selling in a particular jurisdiction. So again, so location becomes really, really important of where the sale takes place. So now we're going to look a little bit at the statutes, and basically we're going to look at KSA 793603. Title 79 is the taxation statute. 36 actually deals with retailer sales tax. And again, for the privilege of engaging in business in the state of Kansas and engaging in the business of selling tangible personal property at retail or furnishing any of the services listed under the statute, there's an obligation to collect and remit sales tax. And again, there's basically four different components of that also. So we are looking at, the first is the retail sale, lease, or rental of tangible personal property. And this is what most of us think about when we think about sales tax. It is, okay, I go into Best Buy, I buy my goods, I leave, they ring me out at the register, they charge me 9.15% sales tax. That's the rate here in Topeka. And so that's what most of us think of when we think about sales tax, is the retail sale. And again, how we define tangible personal property means it's any property that we can weigh, see, touch, feel, but it also includes maybe some items that we can't necessarily see or touch or feel: electricity, water, gas, steam, and pre-written computer software. And that's just the legislature decided to incorporate those terms within the definition of tangible personal property. So again, that retail sale is what we think of most of the time, but we also have tax on labor services. And so, but not all labor services, but the labor services to repair, service, alter, or maintain tangible personal property, or if you install or imply tangible personal property into real property, and that's actually contractors, but for the most part. And if you're going to come to the training this afternoon, Carl will go over contractors in a great amount of detail, and it is very, very complicated. The retailer side of this is much easier than the contractors. But again, if we repair, service, alter, or maintain tangible personal property, so if we do like car service repair, well, we are repairing or servicing tangible personal property. That is a taxable event. If I have a shirt and I take it to seamstress and they sew on a logo, that is a taxable service because, again, they are altering tangible personal property. If we take our pet, our dog, and have it groomed, that is, again, maintaining or servicing tangible personal property. I know dog owners or cat owners or animal lovers don't like to think of their animals as tangible personal property. We think they're members of the family and stuff, but as far as the statute is concerned, they are considered tangible personal property. With that being said, there are some services that aren't taxed. So, anything, if you go to a doctor or a dentist, a hairdresser, a barber, again, they may be servicing or maintaining, but they are servicing or maintaining a human being. And that human being is not considered tangible personal property. Work that accountants do, lawyers, those are outside of that. That service is not taxable. If you do mowing is not taxable. You're basically taking away grass and that type of thing. Snow removal, trash hauling, those are examples of services that aren't taxable. So again, we have some labor services out there in addition to the retail sales. The third broad category is admission. So if we go to a basketball game or a play or a concert, generally we pay sales tax on those admissions into those type of events. And finally, warranties, and it's kind of interesting on warranties. If the warranty calls for performance of a taxable service, then the warranty is taxable. So for example, I buy an extended warranty on my automobile. Well, if we saw earlier that if we're going to repair or service an automobile, that is a taxable service. Well, in this case, that warranty is covering a taxable service, so it would be taxable. Now, if I have to make use of that service, then at that point, there's no tax on that, with the small exception if that warranty has a deductible. So let's say I have this extended warranty and I need to have work done, and I have a $2,000 repair done. But I have to come up with $100 of that $2,000 out of pocket. Tax is collected on that $100, but the other $1,900 falls under the warranty and would be non-taxable. So that just some additional information, but just to have you kind of realize that, yeah, sales tax, when we talk about it, we're talking about retail sales, labor services, admission, and warranties. When we talk about sales tax, what do we charge the tax on? We already said we're going to use that combined rate of the jurisdiction that we're in. So we're going to look at the state portion, the local portion, and if there's any special jurisdiction or special districts on there. So we know we have to use that rate, and we're going to try to figure out what rate we actually have to use. But what do we charge that rate on? And in statute, it is called gross receipts. So it is the total selling price. And that would include shipping, handling, freight, or delivery. A little bit of a spoiler alert, that may be part of that may be changing. And we'll talk about that here in a minute or so. But again, so we're going to look at, okay, what do I charge sales tax on? It is the total selling price. So in our example, we have a $100 item that was sold. We have a $10 shipping charge, and we have a $20 COVID fee. Some of you may be seeing right now too fuel surcharges. So we may be having an additional $10 added on because fuel prices have been higher. Again, that would be added into that. We come up with a total and we would charge sales tax on that total. So in the example you have, gross receipts are $130, and we're going to apply the tax of 9.15% on that selling price, or come up with a total amount due of $141.90. So again, that's kind of how that works. Now, I did tell you this may be changing, and it will be changing for starting July 1st of 2023. If you have shipping charges, handling freight, and delivery charges, if they are separately stated on your invoice, you will not charge sales tax on that. So currently, if you look on the left-hand side of your screen right now, this is how the law is currently working. We have a shipping charge of $10 in that example. Again, we come up with a subtotal of $130. Sales tax here in Topeka is 9.15%. So that's an additional $11.90. We come up with a total of $141.90. A year from now, again, we're going to take the $100 item. We're going to look at the $20 fuel charge, and we're going to come up with a subtotal of $120, and we're going to charge sales tax on that. The $10 shipping charge, assuming that it is separately stated, will be added onto the ticket. Yeah, we're going to eventually owe $140.98, but you will not charge sales tax on that shipping charge if it is separately stated. And again, that goes into effect July 1st of next year. So that is going to be something a little bit different than we're currently used to, but something to keep in mind. Okay, so when you bill the customer, there is a couple ways under statute that you can bill it, but you have to indicate or show that sales tax was actually paid on the purchase. And one method is what most of us are used to. We go to Best Buy, we go to Dillon's, we go to Walmart, we get that receipt, we see the subtotal, and we will see that sales tax is added at the end, and it comes up with the total amount we have to pay. That's what most of us are most used to. Statute does allow for an alternative method there, and that is to just, you don't break down the sales tax or break it out and list it as an individual item, but you say all applicable sales tax is included. And you sometimes see contractors maybe doing this a little bit because they don't necessarily want to demonstrate or make it apparent what their markup is. So again, in both cases, we have an amount due, a total amount due of $108.95. And the first example, we have the sales tax separately listed. In the second example, we said, yeah, you owe us $108.95 in all applicable sales tax is included. So again, you have to do one or the other of those, because the presumption in statute is if you don't list it out individually or don't include that language, that sales tax was not collected. And you really don't want the auditors walking in and them having the assumption or thinking that sales tax was not collected on the transaction. So again, this is something you may want to keep in mind, really, and like I said, comply with, just to save yourself some trouble down the road, hopefully. Okay, so we know we charge sales tax on gross receipts. We know we have all these jurisdictions that we have to look at. But when do we charge sales tax? When do we charge it? And it's usually here in Kansas, we have a rule that's called destination-based sourcing. So we charge sales tax at the rate where the customer takes delivery of the item or where the service is first used. So to give you an example of that, again, I go to Best Buy and buy some goods here in Topeka. When they check me out, I'm taking delivery of that. So they're going to charge me the 9.15% here in Topeka. I can also drive down to Wichita and get the same merchandise from the Best Buy down in Wichita, and it would be 7.5%. And again, I'm going to take possession of that in Wichita. And so that's the sales tax that they're going to charge me. And that's all I owe since the transaction's occurring in Kansas and I'm taking delivery in Kansas. Same is true of where the service is first used. Again, let's say I take my automobile to be repaired, and let's say I live in Topeka, and for whatever reason, I like this repair shop in Lawrence. I drop the car off over there. They call me when it's done. I go over and arrange and I pick it up and I get in, drive home. Well, I'm making first use of the service, of the repair service there in Lawrence. That's where the repair is being made. So again, I would pay sales tax on the Lawrence sales tax rate. So again, where we take delivery or where the service is first used, like I said, and that is called destination sourcing. And again, like I said, this can become really complex because, like I said, we have all these taxing jurisdictions out there. And so how do I know that I have the right jurisdiction when I'm looking at this or deciding what to charge a customer? Well, we do have on our website, ksrevenue.gov. If you go to that website, we do have a tool out there that will hopefully help you. You go to the website, you scroll down, you're going to have to scroll down a little bit. It's a little, when you pull up, you're just going to see the top portion of the screen. So you'll need to scroll down a little bit, but you'll see on the right-hand side about 2/3 of the way down, there are those little blue boxes. One will provide you a link to the customer service center, give you some contact information, but what you're looking for is the tax rate locator. So you will click on that, and then it will pull up the screen in the bottom right-hand corner of the slide, and you'll say calculate tax by address. And it will take you to this link. You will put in the house number, the street name, the city, zip, and we really, to be as accurate as possible, if you really need to be using the zip +4. So not only the zip code, but the +4 digits on that zip code also. If you have a problem or don't know the +4, you can go to the United States Postal Service. Again, you can try to find a zip code by address. Again, you will enter the address information and it will kick it back and it will give you the +4 on the zip code. Jot that down, go back to revenue screen, you put in that +4, and then it should return a screen much like what you have in front of you. It will tell you the combined code or what jurisdiction it actually is. It will give you a breakdown of how much of that sales tax is a state, how much of it's county, city, the special district. And then it will also give you a request number. If you're really questioning what a sales tax rate needs to be and you've gone through this process, again, you will want to copy this page, and particularly you'll want to copy that request number because that shows that you are trying to, again, if audited, it shows that you are trying to do your due diligence to comply and be as accurate as possible and actually pull in the correct sales tax rate. Again, so you may want to print this off. You may want to attach it to your invoice, just to your copy of the invoice, just to show you exercise that due diligence and really trying to comply and collect the correct rate of tax. Okay. With that being said, if you're a retailer, and particularly if you do internet sales and you sell to somebody outside of Kansas and you ship to them outside of Kansas, Kansas has no sales tax jurisdiction on that transaction. It is not occurring within the boundaries of the state of Kansas, so we don't have the ability to tax that transaction. Even though you may be a retailer based in Kansas, but delivery is occurring outside. The end user or end user is taking possession of that tangible personal property outside of Kansas. So there is no sales tax due and owing to Kansas because it's outside our boundaries. Now, while that's all fine and good, if you are doing a transaction and you are shipping it to a individual in Missouri, you may have a Missouri sales tax issue. And if you are a retailer and do a lot of internet transactions and do a lot of shipping to various states, you may have a taxing issue in several different states. So that is something you may want to look at. But as far as Kansas is concerned, you making a sale, but you're delivering it to somebody outside the state does not result in a taxable event here in Kansas. And this is probably one of the biggest issues right now is, this retailer sales tax is generally fairly easy if you are a brick and mortar store and you're selling everything from that store and customers are taking delivery from there. But if you're a retailer and dealing with the internet, like I said, you may be triggering sales tax obligations in numerous states. And there's been a couple of rules over the years in whether a state could require an out-of-state retailer to collect their tax. And back in 1992, there was a case that ended up in the United States Supreme Court, and it was Quill Corporation versus North Dakota. And if many of you are in business, Quill Corporation, they're an office supply store. They do a big catalog business. They do a lot of internet sales now. But they were basically saying, hey, does the state of North Dakota have the right to make us collect sales tax on purchases that are going into North Dakota? We're not even based in that state. We're based in another state. We are making sales into North Dakota, but does the state of North Dakota have the right to say, yeah, we have to register, collect, and remit sales tax for them? Case went to the U.S. Supreme Court, and basically the court said, for states to do that, there has to be some type of physical presence in the state. So yeah, you may not have a retail shop in the state, but do you have employees in the state? Are you making deliveries in the state in your company's vehicles? Is there some type of physical presence, or what they call physical connection? We call that nexus. Is there some type of nexus with the state? And the Supreme Court said, yeah, in limited circumstances, yeah, if you have employees in that state, you have a nexus with that state. If you're making deliveries to that state with your vehicles, you have nexus. So in cases like that, if you have a nexus, yeah, you do, as a retailer, have an obligation to register, collect, and remit for sales in that state. Again, this was decided in 1992 before the internet really took off, but that was the standard pretty much, was you had to have some type of physical nexus. In 2018, this kind of, I don't say it was overturned, but it got expanded quite a bit because we have the Wayfair decision. And again, at issue here was South Dakota wrote a statute that basically said, you know, we're not really going to maybe look, if you don't have a physical presence, okay, but we think that if there's an economic connection or economic nexus, we think we have the ability to tax also. So basically, South Dakota wrote a statute that basically said, if you're an out-of-state retailer and you have $100,000 or more worth of sales in a given year in South Dakota, or you have more than 200 transactions in a year in South Dakota, we think you have an economic nexus, and we believe we have the ability to make you register, collect, and remit sales tax. Case went up to the United States Supreme Court, and the United States Supreme Court agreed. They kind of looked at their prior holding in Quill and said, you know, circumstances have changed. We're looking at 20 plus years. The internet has taken off. Internet sales are just much more. So yeah, they kind of upheld the South Dakota statute in Wayfair. So again, how that applies then, if you're an out-of-state retailer and you have sales here in Kansas, we do require you to register and collect and remit to Kansas the Kansas Retailer's Compensating Use Tax. So even though you're outside the state, you're delivering to people inside the state making those sales. We're kind of following the same suit based on the Wayfair decision. And again, we actually introduced and passed legislation in 2021 with Senate Bill 50, but we actually set that $100,000 standard. So if you have $100,000 worth of sales, it does trigger a registration, collecting, and remitting requirement. And we are by no means unique. Kansas is by no means unique. Most states, when Wayfair was handed down, you can kind of see that they have all kind of developed their own laws or their own thresholds. You see a lot of states using the $100,000, and again, a lot of that is because the $100,000 was the threshold in Wayfair. But if you go through that list, you can see Alabama doesn't trigger until $250,000 worth of sales. California, you have to do about $500,000 worth of sales. So again, 100,000 is kind of the low end of the threshold. And again, that's because the court allowed it in Wayfair. So that's why you see a lot of this 100,000 or 200 transactions. So that kind of brings us into Streamline 2. And what is Streamline? We talk about that quite a bit, but Streamline is a compact between states with the goal of minimizing cost and administrative burdens on retailers, particularly those retailers that are making sales in multiple states. So it really, and what we try to do, what Streamline states try to do is have some common definitions. Again, we try to consolidate some forms and stuff, but again, we're really trying to minimize the cost and administrative burden for retailers. Currently, there are 23 states that are subject or have adopted this Streamline agreement in its entirety. Those are listed in kind of the turquoise blue. Kansas is one of those states. There are 22 other states. And then Tennessee has adopted most of the provisions, but not all of them. But so there are like 24, so about half the states right now are Streamline states. So where this might benefit you too, again, like I said, one of the biggest issues is retailers operating and doing sales in multiple states. And so if you sell in a lot of different states and you're based here in Kansas, but you're making these deliveries and sales to other states, and you're creating all these nexuses with the other states, and you're required to register, remit, collect, and remit, well, then you might want to look at a service that is offered by Streamline. They have what they call certified service providers, and you can contract with them, and they can look and try to handle your reporting requirements with the various different states, particularly if you're in multiple states. And part of that service can be free, but to receive the free service, you'll see that there's certain criteria that have to be met. But again, this may be a great resource if you're doing, like I said, a lot of internet sales in multiple states. So this is something you really may wish to consider. Okay, so jumping back to sales tax, the cardinal rule is most sales are presumed to be taxable unless you can show a reason why we shouldn't be collecting tax. So again, the presumption is the transaction is taxable. So again, you either show that you're charging tax or you have a reason not to, and usually that is an exemption certificate of some type. Or if you are making deliveries to customers outside of Kansas, you want to keep a copy of that shipping invoice with the customer's address on there showing that you collected that. Or not that you collected, but showing why you did not collect sales tax on that transaction. Sorry, Matt. So again, so basically collect sales tax or have a good reason why you didn't charge sales tax. And with that being said, there are entities in the state that are exempt from sales tax for their direct purchases. So, you know, if the federal government makes a purchase, if the state of Kansas makes a purchase, political subdivisions, so cities, counties, townships, fire districts, ambulance districts, if they make purchases, they should be able to give you an exemption certificate, and they should be able to purchase those things tax-free. Also covered with that are churches. Most churches, well, all churches are, it's written into statute that they are tax exempt. So any direct purchases by them should be exempt from tax also. So again, got a great example. Pastor goes into a grocery store, buys grape juice for communion. Checking out, cashier knows him. Hey, pastor, how are you doing? Pastor says, I need to pay for that. Gives the cashier a credit card with his name only. And he goes, oh, by the way, this needs to be tax exempt. It's for the church. Cashier is really on their toes, and they go, sorry, pastor, we can't do that. This is your credit card, your personal credit card. It is not a direct purchase. And he goes, oh, yeah, you're right. Goes back into his wallet, pulls out the church's credit card. Has his name on it too, but it has the church's name. Cashier says, yep, that's great. They scan it and they're good to go. So again, but we're really looking at direct purchases. So in this case, if it's a political subdivision, it really has to have the credit card, either has to have that political subdivision's name on it or the church's name on it, or it has to be a check drawn on the church or the political subdivision, something like that. I can't go in as a state employee and we're out on the road and I decide to pay for a hotel room with cash. I cannot give cash and say, oh, can we be exempt from sales tax on this? Because it is not a direct purchase at that point. Now, if I use my credit card that has State of Kansas, Department of Revenue, and my name on it, then yeah, that and that can be tax exempt. But again, you have to have the name of the exempt entity on there. And that leads us to a second thing. A lot of people assume that all nonprofits here in Kansas are exempt entities. They are not. I think people think that is because churches are, and that is written into statute. So I think people say, well, churches are, so all nonprofits are. No, that is not the case. Before I came here, I was a finance officer for a nonprofit, and we paid sales tax on all of our purchases. So it's not automatic. Now, I will say, if you do have our handout, if you have our publications, our publication 1520 on page 16 does show a list of organizations that do qualify for exemption. And you're going to go through there and you're going to say, well, Roger, there's a lot of nonprofits in there. And I'm going to say, yeah, you're absolutely correct. But those nonprofits wrote in and had special legislation passed for them to get that status, or that exempt status. It is not just a blanket nonprofits. They had to actually get special legislation to be incorporated into the statute to provide them that exempt status. So again, just kind of remember that not all nonprofits are automatically exempt, but we do have exempt entities out there. And if they give you an exempt entity certificate, then yeah, you can generally let them purchase what they need to without sales tax. We also have exceptions in the statute for specific items. So if, for example, if you have purchasing integrated production machinery and equipment, so your manufacturing process, you buy equipment to aid in that manufacturing process, purchase that without tax. You'll have to do an exemption certificate for that, but it can be purchased without tax. Same thing if you're a warehouse distributor and you have warehouse equipment, machinery and equipment. There's an exemption in statute for that. Sometimes it's how you use an item. If you use an item, you may qualify for exemption. So if it's an ingredient or a component part, so I make cheeseburgers, and we'll go into this example a little bit more later, and I buy hamburger. Well, that is an ingredient of selling cheeseburgers, so that could be exempt. If I am in the business of reselling tangible personal property, the inventory I buy for resale could be exempt. And then there's, and a lot of, another example would be if I'm engaged in farming, part of the items I buy for farming, if it's used directly in the production of food or livestock, and it's used only for that purpose, many times that machinery and equipment or feed and fertilizer and that can be purchased exempt from tax. So again, sometimes we look at the uses of the item, or the statute looks at the uses of the item. Again, tax exempt entities, I was referring to this just a couple minutes ago, but again, you find this on page 14 of publication 1520, but it will kind of give you a list of entities that are tax exempt here in Kansas. And with that being said, this is what sales and use tax entity exemption certificate should look like. The buyer should provide you with this document. So when they're coming in and making their direct purchase, they should provide you a copy of this. You need to retain that and hold that in your files. Now, if you have multiple transactions in a year with this, let's say you're a retailer and you're a hardware retailer and you do multiple transactions with a church. Church does not need, and you don't need to require this every time the church comes in. You can take one of them as blanket, and as long as you're having more than one sale occurring with the entity every 12 months. So, if that church comes in 2 or 3 times a month to purchase something, you just need to have this document on file. Again, these documents are issued about every 4 years from the Department of Revenue to the exempt entity. So you may want to look at that to what you have on file, and if they are coming in pretty consistently, but if it's past the expiration date, you might want to be asking for a new one in that case also. And again, and like I said, sometimes if you read the instructions to the information in here, it will tell you how the certificate can be used and what they can purchase with it. And they will say that it will highlight that it needs to be a direct purchase. So it can give you a lot of useful information. So you may want to keep your eye on that. We're going to look at a couple of more exemption certificates. This one is a really very common one. It's the ST28A. And if you are in the business of selling tangible personal property, you are going to take this to your vendors. And this is how you're going to buy your inventory without tax. So you would fill that out. And again, you are going to give that to your vendor from whom you're making purchases. And you're basically saying, hey, I'm not the end user. I'm going to buy this. I'm going to turn around, resell it. So you're not going to charge me tax, but I am going to charge tax on the people I sell it to. And that's the theory here in Kansas, that sales tax is paid one time by the end user. So again, if you're in business and you purchase inventory, you're going to be very, very familiar with that resale exemption certificate. And please, if you get this, the seller needs to retain this. Do not send it to the Kansas Department of Revenue. We will just send it back. We don't need to see it. The only folks from the department that are going to need to see it are the auditors, and they're going to want to see it when they're actually on site looking through your records and doing the audit on site. So again, we don't need to see it, but you certainly want to retain that certificate. Probably if you're engaged in making products, the ingredient or component part, you're probably going to see or use this quite a bit. And again, getting back to our cheeseburger example, let's say I have a little storefront, I'm selling burgers out of there. So I would use this to buy my ingredients. So I'm going to buy my buns, I'm going to buy my hamburger, I'm going to buy my cheese, I'm going to buy the lettuce, tomato, onions, ketchup, mustard, salt, pepper, meat seasoning, buy all that stuff because that's going to be ingredients. Along with that, and if I sell French fries, shake mix, also going to sell, if I wrap the burgers up, that's going to be covered under this. If I have boats for the French fries, if I have cups, lids, straws for the drinks, that's all going to be covered. If I have paper sacks so you can carry it out, that's all going to be covered under this ingredient or component part exemption certificate. So anything that becomes part of the product you sell, so that's kind of what we're looking at there. We also see this in manufacturing. If I'm manufacturing items and I need, raw materials, I purchase those for raw materials, I'm going to purchase that without tax. And again, the whole concept is whoever sells the constructed goods in final form, they're going to be the ones collecting the tax. So again, this ingredient or component part exemption certificate is used quite a bit, and it's the ST28D. We also have a multi-jurisdiction exemption certificate, and this is really very useful if either the buyer or seller is outside of Kansas. So if one side of the transaction is outside of Kansas, you'll probably want to use this for the exemption. The only qualification with this, if where both parties are within the state, is if you are a wholesaler and you don't, or you're a wholesaler doing business with a wholesaler who does not have a registration number. They don't have a registration number because they're not making retail sales. So that would be the only instance in where both parties could be within the state of Kansas where you would use this particular exemption certificate. And finally, there's a generic streamlined sales and use tax exemption certificate. Again, it tries to cover all the bases. Again, you're going to have to check and make sure if you want to use this that the exemption that they're asking for is allowed under Kansas law and stuff, but this is also available for you. So with that being said, if you're a business and the tools of your trade are you cannot purchase them without sales tax. So going back to our example of my little cheeseburger storefront, the grill, I can't buy that without sales tax because I'm going to be the end user. My sear plates, my deep fat fryer, my spatula, all that is going to be considered tools of the trade. If I have a counter in there, the stools, chairs, table, those are going to be fixtures. I can't purchase any of those without sales tax. I will have to pay sales tax on those items. Same is true if I go into the business of accounting and I open an accounting office, desk, computers, calculators, those are all going to be subject to sales tax. They are the tools and equipment that I need to use to perform my job. So unfortunately, those are all taxable. Record keeping, again, we hope you don't get audited, but you do need to maintain some records. And quite honestly, probably this isn't going to be too much different than keeping records for your financial audit if you're going to have one of those. But you're going to keep records of your gross receipts of sales. You're probably pulling those daily from your register or however you're doing that, or your invoices. And you're going to keep all of your receipts, whether they're taxable or non-taxable. You're going to keep all of those. Any deductions, any documents that support those deductions, that type of thing, you're going to want to keep. All personal property you purchased, whether it be inventory or it's fixtures, equipment, again, if it's equipment or fixtures, you're probably going to keep a fixed asset record. Inventory is going to be your cost of goods sold generally. All exemption certificates. So again, if I'm selling to the local church, again, we want a copy of that exemption certificate to support that. So those kind of things, if I'm selling to an out-of-state customer and they're taking possession of it out of state, again, that copy of the invoice with their address, the out-of-state address on there. And then probably want to take an inventory. And if you're a retail establishment, you're probably going to take inventory once a year, just as part of your normal business practice. So again, there's some record keeping requirements, but they're really not that far outside the norm. You're probably already doing most of this for your financial statements and your financial audit if you're having one of those done. Here is a copy of your registration certificate. So when you go online and ask for your Kansas retailer's sales tax number, this is what's you're going to get. Please keep this. You need to keep the original, and you should probably hang it someplace to show that, yeah, I'm registered to collect sales tax. But yeah, you need to keep the original. Your vendors may want copies of this, and that's certainly fine. It does not replace an exemption certificate, but if they want a copy of that, it's fine, but you want to hang on to the original. You can give copies of it, but again, you want to hang on to it. Again, talking a little bit about audits. Again, we hope you're not audited, but if you are, again, you want to hold your records for at least 3 years. And if you're audited, from our standpoint, the primary question is, did you collect and remit sales tax, or do you have a reason why you didn't collect the tax? That's what our auditors are going to be looking for. That's a little bit different than the financial auditors, but our auditors, that's what they're looking at. And again, the auditors use random sampling techniques. They're going to look at all your sales for the last 3 years. They're going to pull a random sample out of that probably. If they find any discrepancies or anything, then they are going to project that over the rest of, they're going to project their findings on the sample onto the rest of the collective receipts or whatever they're looking at. So again, that's kind of how that's done. So again, hopefully you're not audited, but like I said, primarily what they're looking for is, did you collect sales tax? And if you didn't collect it, do you have a good reason why? And again, we look at a 3-year period. Hopefully, if you've already have a sales tax registration number, if not, and you are making retail sales, you really need to be looking about getting one. Again, probably you need to look at getting an FEIN number first, because we will really use that FEIN number in most cases. And the FEIN number comes from the IRS. But again, retailer sales tax number, that 004 indicates that that is a retailer sales tax number. The numbers that follow, the 48, 1, 2, 3, 4, 5, 6, 7, is usually your FEIN number. Usually then that FEIN number is followed by an F or an A, and then we have a -01. That -01, 02, 03 just indicates how many business locations you have in the state. So if we know your FEIN and you apply, we can pretty much guess of what your sales tax registration number is going to be. But if you have not gotten a number yet, again, you can go to our webpage at ksrevenue.gov, and you can click under Customer Service Center, where we have the little red finger going, and it will take you over to a login screen where you put in your email address and password. And then Carl and I can't help you much beyond that because we really can't get much beyond that either. But if you have questions, you can give us a call, but we'll probably, once we're past this point, we will probably refer you back to the Customer Service Center. And so that their number is 785-368-8222. And they are very helpful in walking you through and helping you get that retailer sales tax number. Again, it's our Taxpayer Assistance Center, and that is 785-368-8222. If you have any of our sales tax publications, that telephone number is also on the back of those, most of those booklets also. But again, they will walk you through, they will help you get that number. Like I said, they are very, very helpful. I had a issue a couple months ago. A person had a problem and they contacted me, and I was absolutely no help, but I referred them to these folks and they were able to walk them right through it and get the problem resolved. So again, please use that as a resource because they can be very, very helpful. So once you have the number and you're in business and you're starting to collect tax and stuff, then the question is, well, how often do we have to file a sales tax return? And again, part of the application process, they're going to ask in there what you think your annual tax liability is going to be for sales tax. And we realize that first year when you're making the application, that may be your best guess or your best estimate. But again, how this table runs is if you look at that left column, we're really trying to project out what your annual tax liability is going to be. And that's going to determine your filing frequency. So right now, the way the law reads that if you have $0 to $400 of sales tax collection, we basically are going to say you're going to be an annual filer. And so if we're doing a calendar year, you're going to file on January 25th. So 25 days after the end of the period. So calendar year, so January 25th, that's when you're going to file if you're an annual filer. Now, Carl has a great example, and I will say, being from a nonprofit, I made this mistake too. Annual filer is probably one of the worst filing frequencies because you only do it once a year. And if you don't have a large amount of sales, it is really, really easy to forget that. And quite honestly, like I said, from my background of being a finance officer, it's like you have a lot of other things going on in January. You're trying to worry about getting W-2s out the door, 1099s out the door. You have your normal 941 quarterly filing. You have, if you have employees, you have to do your unemployment reporting. So there's a lot of stuff going on in January, and this is really easy to get lost in the shuffle. And I will say I probably did receive a notice or two from the department that basically saying, hey, we haven't seen your annual sales tax return. You might want to think about getting that filed. And again, where I was working, we did, for a couple of years, we did something that we were required to collect sales tax on. But for a number of years that we weren't doing any activity, so they were really just $0 returns. But I could never convince the executive director to shut down the account because she always said, we may be doing something like this again in a year or two. So, but again, if it's $0 to $400, your tax liability, you're going to be an annual filer. If you're $400.01 to $4,000, you're going to be a quarterly filer. And again, it's going to be the 25th day of the month following the end of the calendar quarter. So again, April 25th, July 25th, October, and January. And then finally, if your estimated tax liability is going to be $4,000.01 or greater, you're going to be a monthly filer. So we are just finishing up the month of August. So in that case, being a monthly filer, my August return will be due September the 25th. Again, and you'll see that we have the accelerated monthly. That has gone away now. Nobody has to worry about that anymore. So we're glad to see that go. I know retailers are glad to see that go. The department is glad to see that go, and the legislature is glad to see that go. So again, we don't have to worry about that. Now, after your first year and you have some history and stuff, you may get a notice from the department that maybe they're going to change your filing frequency. Maybe that first year you estimated that I'm going to probably have $300 worth of sales tax liability, and maybe it ended up being $1,000. If that occurred, there may be a good chance that they're going to send something out to you and say, hey, we're going to move you from an annual to quarterly filer. But again, they will base that generally on the history of the prior year. So how does your account look? Well, and what do we need to do, and what are we looking at, and how do we go about filing this sales tax return? Well, again, if you have we have an account management screen, which we're going to put in your FEIN, and all these tax account numbers are going to pop up. What is applicable for you? So in the example we see here, this particular retailer must have some employees because they have a withholding account, and they also have a retailer sales account. So again, you would select which one you need. In this case, it's going to be, we want to do the retailer sales tax return. So we'll click on that. When that pulls up, you want to make sure your tax account number is correct, your business name, your filing frequency, all that information is correct. It's going to also ask you how you're going to want to pay for your sales tax remittance. Generally, most people do ACH debit. And so we're going to ask for your routing number, your account number, and account type. And a lot of folks overlook that account type, but that is very, very important. I have seen where the wrong account type has been checked. It's a savings account rather than a checking, and it will reject. So you may want to pay particular attention to making sure that is correct. And again, so it's going to start pulling up and saying, okay, for what filing period do you want to file the return for? And we're going to say, okay, June 2021. What type of return is this? Well, if it's the first return we've done, it's going to be an original return. If we've already filed a return and have to make a change, that would be an amended return. And then someone may ask, well, what's this additional return? And it may be an instance where you may have this is where you maybe want to, if you're an annual filer and you do some type of sales transaction in January or February, much like we did at my nonprofit, and we do the sales then and we collect the sales tax, well, maybe we want to go ahead and make the remittance right then and there and not wait till January. So you may do the additional return then and just show the amount of the remittance or how much you collected. And then come January 25th the following year, you go back in and say, okay, this is the original return. Those two things will be married up, and you can say, yeah, we already made the payment on this. Here's the liability. But again, you may use it for something like that, so you just don't forget those sales and you have that money back in January and February. Part 3 will ask you if you want to remember prior period jurisdiction codes. That is very helpful because you certainly have, if you've already gone through and you're working in multiple jurisdictions, you don't want to go through that list every month of what jurisdictions you are, particularly if those jurisdictions are reoccurring. If you don't select anything, it will just pull them all up. And again, you get to go through all those 1,000+ jurisdictions. And finally, you may want to indicate if this is a zero-based return or you had no sales. So obviously, if you had no sales, there was no sales tax collected. So zero-based return. So you may want to indicate that. Again, you may want to look at this information before you start actually filing it, putting in numbers and that type of thing, make sure everything looks correct. And this is what, if you don't select what to use prior period jurisdictions, this is what that screen is going to look like. If you don't make that option, it's going to list every jurisdiction out there, and then you're going to have to go through and select which jurisdictions you need. or which jurisdictions you need to include with your return. So then we actually go into filing the return. And like everything else, we kind of do this backwards. That sales tax return is comprised of parts 1, 2, and 3. Well, obviously, then we are going to start with part 3. That's where you're going to start. And so what you're going to do there is you're going to list your gross sales for each jurisdiction. So if you're in multiple jurisdictions, what your gross sale is for each of those jurisdictions. Then you're going to look at, add to that any merchandise that was consumed by you. And what we mean by that, if you're a retailer and you're purchasing your inventory tax-free, and let's say clothing store, and I have a clothing store and there is a pair of shoes that I really like, and I say, hey, I'm going to pull this out for myself. Okay, do that, but I haven't paid tax on that because it was my inventory. I am now the end user of that. So that merchandise that I pulled off and I'm going to use for myself, I have to pay sales tax on that at the price I paid for that inventory. So again, so merchandise consumed by you, gross sales. So we want to include all that. And then we're going to take out our deductions or our exemptions. So we are going to, you know, if I make a sale to the church, or if I sold something that qualified for the ag exemption, I would take that out there, and I'm going to come up with net sales. Now, what's really, really important on that gross sales and the merchandise consumed by you, you have to report that net of tax. So you may have to back into those numbers if your POS system doesn't do that. If your POS system includes gross sales tax as part of gross sales, you may have to back that number out. And why I say you have to do that, because you look, we're going to take gross sales, the merchandise consumed by you, minus the deductions, and that's going to be net sales. And then we're going to take it times the tax rate for that jurisdiction and come up with the net tax. So if your gross sales include sales tax you have already collected, you're going to be paying more tax than you really need to. So again, it's very, very important that gross sales and merchandise consumed by you does not include the sales tax collected on those transactions. So anyway, like I said, you do that for each jurisdiction, and you're going to want to keep a running total before, once you're done with this, you're going to want to see what your total deductions are, because that's going to be the next portion of filling out that return. And so we got a total amount of deductions. Well, now we start breaking those deductions down in part 2. So what part of our sales were sales to other retailers for resale? What portion of those sales were to the state of Kansas or a political subdivision? What portion of those sales were consumed in the protection of tangible personal property? What was the sale of farm machinery and equipment? So deliveries outside of Kansas. So you're going to categorize all those deductions, and hopefully your part 2 should total your deductions in part 3. So those two should balance out. And if you made a sale with an exemption that is not listed here in part 2 of the deductions, you do have that very last entry and other allowable deductions. That's where you would report those. So hopefully you've entered all that, your deductions total to part 3. And so now we just go back, and part 1 actually is looking at the tax collected. So 1, total tax, that should auto populate for you because it's going to base that off the information you entered in part 3. So again, you probably are not going to do too much with line 2, most of you. So again, the tax 732. We don't do the accelerated tax anymore, so lines 4 and 5 probably are going to remain blank. You may have a credit memo out there, so if you're wanting to apply that credit memo, you may use that on line 7. Penalty and interest won't be applicable unless the return is late, and quite honestly, if it was me and the return was late, I wouldn't attempt to do the penalty and interest calculations. I would probably just submit it and let the department's computers determine what the penalty and interest on that is. But just remit what is due at that time. But hopefully, if you're filing timely, the penalty and interest won't be an issue at all. So again, so that's basically how that electronic return works. Like I said, it seems a little bit backwards. We start with part 3 and then we work our way up, but that's how it works. Again, we're going to look at, okay, how do we plan to pay this and when do you want it paid? Again, most of you are going to use ACH debit, so that basically allows the Department of Revenue to go in and pull from your bank account at a given date. And again, so it'll probably ask you to confirm your bank routing information, your account number, the account type. One thing I do want to make you aware of, even though the due date may be the 25th, when you're doing these ACH debits, banks need a little bit of lead time. So you may want to talk to your financial institution. I think most of them, you have to have that information in at least the day before. So if you're wanting to pay something by the due date and it's July 25th, you may need to have it in by July 23rd or July 24th, depending on your bank. So you may want to talk to them about how that actually is done, how much lead time they need. But again, well, and again, we have some information out there too. We're saying, in addition, payments entered after 4 p.m. Central Standard Time cannot be effective for the next business day settlement. So you may want to look at that too. But yeah, you may look at that, and like I said, you just can't come in here on the 25th and do that. You may need, like I said, need to have a little bit of lead time on there, or the remittance portion of that may actually end up being late, and you certainly don't want that. Once you have it filed, then we're going to give you the summary page, and it's going to kind of give you what the tax was, tax amount due. It will summarize your deductions. It will summarize your Part 3 information. Again, you may want to print this off and keep it with your records. And then once you've looked it over and confirmed everything, you may want to submit the return. Like I said, you may want to keep the previous page in your records. You definitely want to keep this page for your records, because this page has a confirmation number, and it shows that the return has been filed, and it shows the date that it was filed. So you definitely want to hang on to that. That is, again, part of your insurance that we did file the return timely. And we do keep history of those returns out here. So, you know, if you do have a question about a certain return and filing period, you can go out there and pull up that information. We would encourage you, though, that this should not be your only source. Your own record should have this information also. So, you know, keep copies of your returns, the backup documentation for that. Again, we have that information out here, but it should not be your primary source of history for your sales tax returns. And then if your business really starts taking off and flourishing and you need to add different type of tax accounts. You can go in there again. Once you've established one account, it's pretty easy to add others. So said if you started out as a retailer and it's just kind of you, but now you're being very successful and you are adding employees, well, now suddenly I need a withholding account number. And let's say we even get more successful and we go, well, do we still want to do this as a sole proprietorship? Maybe we want to incorporate. Maybe we want to become a C Corp. And if that becomes the issue, then you may want to file and set up a corporate income tax account. So again, if you have to add accounts onto here, it's pretty simple to do, particularly once you have the one account established. Adding is pretty easy. And again, if you're needing to add accounts and you need some assistance, again, that customer service number at 785-368-8222 is available for you. So kind of done with the retailer sales tax, jumping to compensating use tax. Guys are real quiet today. Is there any questions or anything at this point? Okay. Seeing none, we will jump into compensating use. Compensating use tax has been around as long as retailer sales tax has been around in Kansas. So they were both passed in 1937. So a lot of times people don't know that there is compensating use tax until there is a retailer sales tax audit. And if our auditors are auditing you for retail sales, they're going to audit you for compensating use at the same time. So compensating use is a little bit different. Like I said, retailers, usually the sale is occurring here in Kansas. Possession, the buyer is taking possession of it here in Kansas, and that's when sales tax is collected. Compensating use tax is kind of a little bit different. You're actually buying something outside of Kansas. So you're going to buy something in another state. You're going to bring that back into Kansas to use, store, or consume. And what the kicker is here, so you're buying it in another state, you're bringing it back into Kansas to use. And this is true of both retailers and consumers. So the kicker here is we have to look at what sales tax was paid in the other state. And if there was no sales tax paid in the other state and you bring it back into Kansas, well, we're going to charge compensating use tax at the rate of where you are using, storing, or consuming that property. So in my example before, let's say I go to Kansas City, Missouri, Best Buy, and buy a laptop computer. Okay. For whatever reason, let's say Missouri doesn't have a sales tax. I bring it back into Kansas, use it here in Topeka. Technically, I should file a consumer use tax return and pay the 9.15% tax on that purchase. So again, that's compensating use is a little bit different. We're bringing something in the state in which we paid no sales tax, or we paid sales tax at a rate less than the rate where I'm using it, storing it, or consuming it. So in my Missouri example, again, if I bought that same computer and paid 6% on it, and then I come into Kansas and use it here in Topeka, then I have to pay sale compensating use tax on the 3.15% difference. Now, this does not work in the reverse. If I have to pay 10% in Missouri and bring it into Kansas and our rate is 9.15 where I'm using it, I don't get a refund of that difference. but that's how that compensating use tax works. There are exemptions to it. So the sales tax exemptions apply to compensating use tax exemptions. So if I would have made that purchase in Kansas and it would have been exempt from tax, from Kansas sales tax, that purchase done in another state is also exempt from Kansas compensating use tax. So even though it occurred in another state, if the exemption qualifies, I would not have sales on or compensating use tax on that transaction. Okay. Again, compensating use tax, what rate we use is the same rate as the sales tax where the item will be used, stored, or consumed. And again, if we have questions about that, we can go through that sales tax rate locator that we walked through earlier today or earlier this morning. So again, we can use that for the same purpose here to determine what is the actual tax rate we need to be using. And so again, what do we charge tax on? Well, it is our total purchase price. So again, we're going to include the shipping, handling, freight, delivery, and any other charges. So again, we paid $110 for the item. If we paid no tax on it and we bring it back and use it in Topeka, that $110 is going to be subject to the tax at the 9.915 rate, 9.15% rate here in Topeka. So hopefully that makes a little bit of sense there. Audit, yeah, like I said before, if you're audited for retailer sales tax, you're going to be audited for compensating use tax also. Again, you want to hold on to your records for at least 3 years. Again, the question here is, did you buy tangible personal property outside of Kansas and brought it back into Kansas and used, stored, or consumed it? And did you have, was there a difference in tax that you had to pay on that, or did it qualify for one of the exemptions? But that's what the auditors are going to be looking for. Did you bring something back into the state to consume, use, or store, and should a tax been paid on that? And again, they're going to look at a 3-year period. They're going to take a sample and then project their findings over the 3-year period. And again, if I'm purchasing office supplies, furniture, computers, subscriptions, the tools of my trade out of state and bringing it back into Kansas, again, I would be subject to compensating use tax on those items. Again, you can register for compensating use tax. You can see we have a couple of numbers there. 006 is generally a consumer. So that was me as an individual. Like I said, I go out of the state, purchase something and bring it back to use in Kansas. I would probably have to register, get a tax ID number, and file a tax return, a consumer's compensating use tax return. We used to, up until a year or so ago, you could actually report your consumer compensating use tax on your individual income tax return. We no longer do that. So, but up till a year or so ago, that was an option. If you're an out-of-state retailer, yeah, we're going to ask you to obtain a retailer's compensating use tax number. And again, how you get it is you register online at ksrevenue.gov and kind of go through those steps again. So once you have your number, then again, how often is the return filed? Again, we're going to look at what the annual tax liability is. And again, this should look very, very familiar. It follows the retailer sales tax exactly. So if it's $0 to $400, we're going to be an annual filer. If it's $400.01 to 4,000, it's going to be quarterly, and anything over $4,000.01, you're going to be a monthly filer. Again, the due date will be the 25th day of the month following the end of the year, quarter, or month, whichever is applicable. And like I said, if you're an individual and you need to file a consumer's compensating use tax return, that is a CT-10U. You can pull that from the website. And I thought we had a picture of that, but we don't have a picture of that return. But
Hey, I think there's a question for you.
okay.
So it's what if you purchase goods in Kansas state and they should have sales tax, but sales tax wasn't charged by the retailer. So is that still compensating use tax?
In that instance, no, I think that is the scenario we were looking at, that something was purchased here in Kansas. We're taking possession of it here in Kansas. Sales tax should have been collected on that. It wasn't. No, you wouldn't file a compensating use tax return on that because the sale is occurring in Kansas. It did not occur outside of Kansas. I don't know exactly how you would address it. I guess you could go back to the retailer and maybe have them re-ring it or redo it and collect the tax in that fashion. But yeah, you wouldn't want to handle it through a compensating use tax return because that's not what's occurring here. You're not purchasing this outside the state and bringing it back in. You actually purchased it in Kansas, and it may be more your vendor having a problem with that because they're going to be the ones that have to show why they didn't collect sales tax on that transaction. And that's probably more of a problem for them than it is the consumer in this case. But like I said, if you're trying to make it right or feel obligated to do that, like I said, I think probably the best thing maybe to do was, if it's been fairly recent, to go back to the business that you purchased it from and have them maybe do a return and then have them re-ring it with the tax on there would be my best advice at this point. So any other questions? Okay. Like I said, kind of finishes that up. Again, just remember that retailer sales tax applies for transactions in the state where the buyer is taking possession or taking possession of the property or first using the property in Kansas. The buyer pays the tax, but the seller collects and remits it. Compensating use is a little bit different. Compensating use is I'm buying it outside the state, I'm bringing it in the state, but as the consumer, I'm responsible for remitting the tax in that instance and filing the return. So again, there's a little bit of difference there on how those work. If there's any other questions, we'll be glad to address it. Or like I said, if you want to contact Carl or myself directly by email or by phone, more than happy to do that. Again, here is our contact information. Want to thank you for hanging in there with me today. Spending 2 hours on sales tax is not probably the best way of spending a morning, but hopefully you've learned a little bit of something. And again, hopefully we're available for you if you have questions. So with that, I want to thank you for attending today, and if you're attending the contractors this afternoon. We'll probably see Carl about 1 then. Thank you.